Welcome back. So, having a pro forma is like having a roadmap for your business's financial future, providing clear guidance and insights to help you make informed decisions and achieve your goals. Here, we're going to cover three key benefits to having a pro forma. Benefit number one, it's going to attract investors. And this is one of the most important ones. So, when you're going out and seeking either debt capital or equity capital, investors will want you to communicate your business plan to them clearly and concisely. They're going to want to look at this big, complicated financial model because that's the way that they're going to make sense of the world. And that means that you need to be able to learn this language at least a little bit to be able to communicate with the people wearing the suits and holding the purse strings. Benefit number two, on the other hand, is that it helps provide a benchmark. And what we mean by this is that when you're running your business, whether it's a cannabis business or otherwise, you always want to be able to set goals for yourself. When you track your performance on those goals, it helps you understand where your assumptions that you made previously were accurate and where they may have fallen short or gone just a little differently than you expected. So, this creates a feedback loop for your business and it allows you to help improve it over time. For example, if you had made the assumption that your gross margins last quarter were going to be around 50% and they came in at 55%, you actually exceeded your goal. And maybe when you make a projection for the next quarter, you might bump that up to 55% and try to maintain that level. The third one here is that it actually helps when you're estimating future expenses and revenues to help plan certain business activities. So it can help when it comes to forecasting things like inventory, for example. And this one's really critical because it helps you not only plan how much money you need to raise, but it helps you plan how much profit you're going to earn, when you might turn a profit and break even in your business once it's stabilized. All of these are going to become really clear based on the assumptions that you put in. And they should be pretty accurate too if you can use really good quality assumptions when you're adding them into your pro forma. So the next one here that we're going to talk about is just some terms that you should know. Before we go any deeper, you might know some of these, you might be familiar with them, but we'll run through them one by one. And the more you understand these, the better you'll be able to communicate your business's financial needs to other people. And so it's also important to remember that while discussing money might feel uncomfortable for a lot of folks, becoming familiar with the terminology does help you better articulate your business plan and financial models. And it is a really necessary part of running a business, especially if you need outside capital to get it going. So, working down the list here, accounts payable is accounts payable means money your business owes to suppliers or vendors for goods and services received but not yet paid for. On the flip side of that, accounts receivable means money owed to your business by customers who have received goods or services but have not yet paid. A build out cost means expenses incurred to renovate or set up a physical space for your business, such as construction, fixtures, and equipment. Working capital means the difference between your current assets, like cash and inventory, and your current liabilities, like accounts payable, indicating the short term success or financial health of your business. Terminal value or sale price means the estimated value of the business at the end of a specific period or the price at which it can be sold in the future. Valuation means the process of determining the overall worth of a business based on its assets, earnings, and market conditions. Debt capital involves borrowing money that needs to be repaid with interest. Debt capital can be obtained through loans from banks, bonds issued to investors, or other forms of debt instruments. The company is obligated to repay the borrowed amount according to the terms and conditions outlined in a borrowing agreement. The advantage of debt capital is that the company retains its ownership and control, but failure to repay debt can lead to a financial penalty or even bankruptcy. Equity capital, on the other hand, involves selling ownership stakes in the company in exchange for funds without the obligation to repay. Equity capital can be obtained by issuing shares of stock to investors, either through private placements or public offerings. And investors who purchase equity become shareholders in corporations or members in LLCs, and they have ownership rights, such as the ability to vote on company decisions and receive dividends if that's applicable. Unlike debt capital, equity capital does not need to be repaid. However, it involves sharing ownership and potential decision making power with investors. And now, while there's no obligation to be repaid, all investors are going to expect some type of financial return, and that's why they're putting the money into the business in the first place. This return for an equity investor will come through one of two ways: either a dividend, which is going to be paid out as the company is profitable over time, and those dividends will be paid out typically based on the relative ownership percentage that each equity holder has in the business. The other way that you would get money out if you're an investor is through an exit or a sale. The last one that we have here is inventory cost. Inventory cost means the total cost associated with purchasing, storing, and managing the goods that your business intends to sell. So you'll hear these terms many times through this program and through running your business. The more familiar you can become, the better you'll be able to understand your business and the better decisions you can make about the direction of your business. Coming up next, we're going to discuss the different types of pro formas. So let's dive in. There's a few different types of pro formas you may use in your business. This first pro forma is going to be a sales forecast pro forma. And what is a sales forecast pro forma? If we go back to our hammer tool example, just as there are different types of hammers, there's lots of diverse types of pro formas out there. And we're going to look through them one by one. You'll notice on the slide that there is an input and an output column. An input is any data, information, or assumption that is used to generate a forecast or outcome in a financial model or analysis. An output is the result or the information produced by a process or system. So, a sales forecast pro forma typically is going to reflect your revenue as opposed to your costs. So, we're really trying to predict how much revenue the business can produce in the future. The inputs that are going to be used for this type of pro forma are historical sales data and market trends, and the output would be your cash flow or a projected sales revenue. This pro forma helps businesses plan and make decisions based on expected sales. So if you've been running your business for a while, you're going to be using your historical sales data as an input. For example, if you know you sold an average of $100,000 a month for the last 6 months, you're going to want to ensure that your historical data is then reflected in your future projections. So you're going to consider different market trends as well. For example, in a newly recreational state, there could be 80 or more licenses currently, but there might eventually be a couple thousand licenses of varying different types by the time the whole state has rolled out. And that means that you need to think and communicate in your financial forecasts around the impact that saturation is going to have on your business. So, taking into consideration market trends and your corresponding market strategies are very important. For example, if you're projecting a sales forecast and you spend $10,000 versus $1 million on marketing, you should expect that there's a difference in how much foot traffic you're going to have coming through your business or how many customers you'll have for your business based on the level of marketing that you're performing. So that's going to relate to a difference on the revenue side of things as well as on the cost side. If you spend and invest more money into marketing, you should see a yield and a return on investment on the revenue side as well. So who would you share this pro forma with? Typically, store managers, owners, and potential investors would be really interested in this type of information. You might also share this information with a marketing consultant that is helping you increase these numbers because they're going to be very focused on delivering a specific ROI or return on investment for every marketing dollar that you spend. The next pro forma is a budget pro forma. This one's very simple. It's just going to show everything that you're going to spend money on in your business. So, for example, your rent, your utilities, your salaries, these are going to reflect any other budget that you would have created So, as a business owner, you should be very familiar with this one. This pro forma you would share with owners of the business, store managers, anybody that's invested in making sure that those costs and that budget is maintained. The last one here is the cash flow and working capital pro forma, which typically cash flow refers to the movement of money in and out of a business over a specific period of time. It tracks the inflows and outflows of cash, including revenue from sales, expenses, investments, and financing activities. A positive cash flow indicates that a company is generating more cash than it's spending, while a negative cash flow would mean the opposite. A cash flow is crucial for maintaining operations, paying bills, investing in growth, and meeting financial obligations like debt. Working capital represents the difference between a company's current assets, such as cash, inventory, and accounts receivable, and its current liabilities, such as accounts payable and short term debt. It reflects the company's ability to cover its short term financial obligations with its current assets. Positive working capital indicates that a company has enough liquid assets, liquid meaning available to spend, to meet its short term liabilities, while negative working capital suggests that potentially the business has financial difficulties. Working capital management is really essential for ensuring smooth day to day operations and sustaining business activities. And this is going to be something that an investor and an owner are going to care a lot about because this is how, at the end of the day, they're getting paid. You're likely going to be operating your license and collecting cash flow from your business for a long time. Your investor is going to care about questions like how much money am I going to make off this investment? If I'm going to give you $1 million today, how long will it take me to get that paid back? So you need to be able to tell them at least a decent estimate and prove it with your own assumptions and numbers. And that's where this type of pro forma typically comes into play. The next one here, we do have one more, is the inventory management pro forma. So this one will go into more detail on the operational side. It helps you project your inventory levels and plan reorder dates, quantity, frequency, etc. These types of forecasts are critical for operationally focused businesses that buy inputs and sell products, whether it's a retail store, a manufacturer, or a cultivator. This type of pro forma would be shared with typically an inventory manager or a store manager, people who are really in the day to day operations of the business. The next one we're going to cover here is pro formas in practice. So now that you understand the different types of pro formas, let's walk through a couple of scenarios where you might find that you really need a pro forma in order to answer questions regarding the health of your business and the future expectations of your business. Speaking from experience, it's a lot better to have that tool built before you get these questions rather than after. For example, if a prospective investor begins asking questions about the financing of your business, you're going to want to be able to answer those questions from a very informed place, and you want to be able to provide that answer quickly. If an investor has to wait a long time for a response, they're probably going to judge you for it and make negative assumptions about your ability and the viability of your company. So having this information prepared ahead of time, knowing what your numbers are and the impact of certain decisions that are going to have on these numbers is very valuable. Let's begin with an example regarding operating decisions and how a pro forma can help you answer these questions. Some of these questions might be, can I afford to pay this lease? That's a very complicated question because it's going to involve a lot more questions before you can answer the final question. So, for example, if you own a dispensary, you'll need to ask how much foot traffic is the store going to have based on its location? What's my wholesale margin going to be? How many staff do I have to hire to properly run my business? All of these factors contribute to generating cash flow. If your cash flow turns negative after factoring in lease expenses, investors are going to avoid investing in your business. Ultimately, you may risk losing your business as you need to sustain yourself from that cash flow. It's crucial to calculate these figures in advance. Besides determining the initial investment needed to open your business, which is basic budgeting, you should also consider that more than just knowing your operating expenses. Keep in mind that your business may not turn a profit during its first year. So you have to have extra money raised in the bank to cover any shortfalls that you have after paying all of your expenses, especially during that period of time when you're ramping up your sales. How much inventory do you need? How many employees can you hire? When can you afford to grow your staff? These are other questions you should be able to answer if you have a good pro forma. How much money should you set aside for taxes? That's directly coming from your cash flow from your sales. And so these are complicated calculations, and we do recommend consulting with a tax professional to ensure that you're paying and filing taxes on time and in the correct manner. But these pro formas will help you estimate how much those tax liabilities are going to be. So, the next set here are really specific to management decisions. Are you considering strategic moves like maybe entering a new partnership? Do you want to forecast your personal earnings for the business for the next few years? These are critical questions for many business owners. Despite the challenges in obtaining precise answers, it's essential to try to attempt to build these assumptions as these documents do evolve over time. Next is business goals and plans. Another aspect in communicating your business goals and plans to others, as we discussed earlier, for instance, an investor may inquire about what the next year's free cash flow or may be, or a potential lender may require a profit loss forecast. So, if you're considering selling your store, it's worth knowing what it's potentially valued at. You're going to want to gauge if the market growth aligns with your store's growth trajectory and if you can expect a similar type of return. These are all things you should take into consideration when you're building a pro forma. In the next video, we're going to discuss the limitations of pro formas and things that are really critical to keep in mind. I'll see you there.